Hey, so there's been a lot of talk about the housing market potentially collapsing 30 to 50%. And in this video, I want to give just sort of my real perspective in terms of, do I actually think some kind of 30 to 50% drop in the housing market is realistic? Are all of a sudden homes actually going to be affordable to the point that average everyday people are actually going to be able to afford real estate? And what's my take on all this? Well, in short, no. I don't believe that housing is going to have such a catastrophic downturn. I do expect that housing has vastly peaked in May to June, and now we're starting to see institutional investors across the board pull back. Not only are home builders starting to cancel land contracts and pulling back because they see the macroeconomic headwinds, but they're also sort of evaluating, hey, like, why spend money on housing when we could just buy back our stock, which is relatively cheap? But you are also seeing home rental companies like Invitation Homes finally slow down. Now, they should have pulled back in Q1 of 2022, which is when I advocated for potentially, if you wanted to get out at peak, selling real estate and waiting that cycle out, which is also what I did with my real estate portfolio. However, Invitation Homes still ended up spending about $1.1 billion on rental homes, buying about 2,000 rental homes between January and September 30th. And now for the last 3 months of the year, they expect to spend virtually nothing on homes. I think somewhere around like $70 million, almost nothing relative to what they have been spending. And that's kind of shocking because it shows that Invitation Homes, one of the largest home rental companies in the country, is saying, oh crap, we probably should have slowed earlier. Now we're definitely going to slow and we're going to wait for opportunities. Now, in their earnings call, which we talked about this morning on our course member live stream, which of course we have a Halloween coupon that ends today. Check that out down below before we get into November. The interesting takeaway really was that Invitation Homes isn't trying to time the market. They're not trying to perfectly time the bottom or the top here. They're just trying to say, look, we're going to pause and we're going to wait for better opportunities and then we'll sort of average in. But they're making it very clear that that time is not now, that now we are just beginning the housing downtrend. And this is what I think is so interesting, is that really, do we really think that housing prices are going to collapse like they did in 2008, where we had subprime lending and ninja loans where people couldn't qualify for loans, but they were getting approved anyway with teaser rates of negative interest rates that ended up adjusting 6 months later with the hope that people could refinance, but then they couldn't, so they ended up going bankrupt or into foreclosure. Complete disasters, right? That makes sense. It makes sense to see a 40 to 50% real estate decline when people are selling their homes through short sale and foreclosure because they have to, and they don't actually care what the homes are selling for. In fact, I remember being a real estate agent back in 2010, 11, and people would say, what do I care what the property sells for? Just get the property sold, because the bank is giving me a short seller benefit for going through with a short sale. They were giving sellers $10,000 checks just to say, here, have $10,000. Thanks for going through the short sale process. Here's some money to move. This saves us money not having to go through the full foreclosure process. And even though you're basically dumping on the property and you're trying to sell this property for as little as possible, here's a thank you check for $10,000 for helping us sell this property quicker for less. Like, the incentives were so perverse in the last recession that it makes sense home prices fell as much as they did. But credit quality is so much stronger today. Average credit scores are 100 points higher than they were back then. People have to have the ability to repay. The amount of equity people have in their homes is substantial. Even if property values fell 15%, people would still have equity who bought after the pandemic, let alone the people who bought before the pandemic, who have even more equity than those who bought since the pandemic, right? So we're really not seeing the potential for the short seller and foreclosure crush, but we are definitely seeing a slowdown that finally institutions are recognizing, including Invitation Homes, and saying, okay, yeah, we do actually need to take a little bit of a pause here and stop buying. So where could we actually and potentially see some pain coming from? Like, where can we actually see housing inventory increase? Because so far, we're really not seeing housing inventory skyrocket. Even though sales are falling, which means that we're seeing the month's supply of homes go up, actual housing inventory isn't really skyrocketing. And so this means in order for us to really see a downturn in the real estate market, beyond the 6 to 10% we've already seen in markets. We really need to see the following happen. We need to see investors bail. And right now, we're not seeing that. Right now, what we're seeing is, there we go. We were seeing nothing there for a second. We're seeing investors pause, right? So we have investors pausing. We need, in order to see prices go down, if you want prices to go down substantially, we need investors to bail. Now, these investors could be pension funds, they could be mom-pop investors, they could be institutions like Invitation Homes, right? But really what you're seeing is you're just seeing these investors pause, and not only are they pausing their acquisitions, but they're pausing home builds, which ironically, investors pausing acquisitions could be offset by a slowdown in new housing over the next few years, right? Because new housing takes time. So you really need to see home prices probably extend past 25% declines. You really need panic here. Now, is it possible that we could get to panic? Yes, it is. See, we know that real estate has roughly peaked in about March to May. So the real estate cycle somewhat looks like this right now, where this is your peak over here, somewhere between month 3 to month 5, depending on where you are in the United States, is roughly where you saw your peak. And we've come off of this peak maybe 6 to 8% already. But where we are now, when we look year over year to last October, we're still actually about 8% higher than where we were. So I believe in order for us to see real potential panic, we need to see these year over year numbers be negative, which we'll probably see when we're actually comparing May of next year, which, let me draw that in orange over here. It's getting a little crowded. May of next year might be somewhat where this dot is over here. And that'll actually compare here. And that's where you're going to see maybe this negative 10% decline. And potentially then you get this rotation of, oh crap, it's not homeowners who are going to sell because then they have to move into potentially a higher interest rate, so a home, right? So they're more incentivized to stay put. But it's potentially people with extra real estate, homeowner like mom and pop investors, institutional investors, pension funds that say, oh crap, the Fed is keeping rates higher for longer. They're fighting inflation higher for longer. Mortgage rates are staying higher for longer. We need to dump to create liquidity for the stock market or the bond market or otherwise. And by dumping real estate, we are potentially dumping into a panicked environment where if you dump into panic, where year over year home sales, are negative, that's when you could potentially create this self-fulfilling movement of fire selling. Now, that I expect to be different than 2008, but look, here, this was Pulte Homes. They literally tell you in their earnings report, we cannot be margin proud. We have to sell homes, even if it means aggressive discounting of our existing inventory. This is painful. And it's really, this is where we, in my opinion, see max pain. Max pain in real estate comes from year over year. Let's write these down, okay? So we're gonna write it down together. Max pain in real estate comes from the following. It comes from, we will tab open here. There we go. We'll call it conditions for max pain. Conditions for max pain in real estate. You need year over year declines. We're not gonna see those until March to May 2023. Then you need continued Fed pain because that'll create pain in stocks and bonds. When you get continued Fed pain, now you get investor liquidations, not just a pause. Pause is not going to be enough. You need those investor liquidations. There we go. I apparently can't get this spell today. There you go. These are the conditions for really max pain. However, these conditions would align with maybe a 20 to 25% decline in real estate, which I think is substantial. This would take us back to or just before the pandemic, so like 2019. So you're not going to be back at 2011 prices where you could get that $300,000 home. but maybe you could get that home for $600,000 instead of $800,000, which we kind of saw in like May of 2022, right? So basically, I would see that as like an 800K home becomes a 600K home rather than a 2011 $300,000 home. So affordability will still be stretched, but this is my expectation for investor liquidations at the same time as continued Fed pain and year-over-year declines, leading to really a 20 to 25% decline in the real estate market, which really aligns with about a 45% reduction in purchasing power due to higher rates, but then also this excess buyer demand of about 20%, offsetting that difference between 45 to about 25 because you had excess buyer demand of about 20%. So my opinion, and we'll see, we'll continue to track this, but so far we do not have the short sell and liquidation panic. Maybe we'll get the investor panic, but investors won't generally panic at these levels because it would be highly unprofitable to do so. Whereas short sell banks don't want to hold on to inventory, but we're not actually expecting short sales and foreclosures. So again, this is where I get to what I think is sort of your realistic decline for real estate. I think that'll create fantastic opportunities for HouseHack, and we'll be utilizing a lot of the technology that already exists, especially just this morning we were reviewing Invitation Homes rental management platform. Really great, a lot of things to improve on, but what a great head start to see what some of the industry is already doing. And so we're really excited about HouseHack, but beyond that, do we really think a 2008, 2009 real estate crush is coming yet? No, not quite yet, but probably 15 to 25%, yes. Is that going to affect then stocks that relate to homeowner investments? Home Depot, Lowe's, Enphase, Solar Edge? Yeah, probably. So we'll see. I would just say, for the meantime, buckle up, and thanks so much for watching. Check out those programs linked down below, and happy Halloween.